And now your money's telling you what to do through those emotions: fear, greed, regret, and desperation. Nobody should be making decisions in that capacity when they're faced with those emotions. But sometimes you have no other choice. You have to. It's better to do something than to do nothing at times. So the good news here is that there is a way to protect your savings from market crashes while still having the opportunity for growth. And that's exactly what we're going to talk about today. And that is how annuities, specifically fixed indexed annuities, can safeguard your retirement from market downturns.
Yeah, and I know we've gone over fixed index annuities before, but just because we're considering this time that we're in right now, I do think it's important that we define exactly what a fixed index annuity is for somebody who's catching up now and maybe hasn't seen a prior podcast. So, fixed index annuity is a financial tool designed to give you the best of both worlds, and that's the protection from the market downturn, while still allowing you that growth of your money based on the performance of a specified index or multiple index options, whether that's something like the S&P or NASDAQ or Russell.
Yeah, that's exactly right. And the key difference between fixed indexed annuities and traditional stock market investments is that a fixed indexed annuity comes with a principal guarantee, a contractual guaranteed floor of 0%, meaning that even in these events of market crashes, you'll never lose a dime. So I think we said it on the previous episode, it's a sleep at night annuity. It allows someone to have the assurance that no matter what happens with all of the uncontrollables of the market, your principal is contractually protected, and you're never going to lose a penny due to things that we can't control. So, in the years when the market's doing well, though, you can participate in some of those gains either with a cap or a participation rate strategy, but never risk any of that downside loss. So, a lot of benefits there to keep someone with peace of mind, confidence, and clarity as they move through the pivotal years of retirement. And that's usually the few years leading up to it, few years after, are what we refer to as that retirement red zone.
Yeah, yeah, and that's exactly where the fixed index annuity is valuable. Is that during uncertain times like right now, like what we're seeing, while traditional investments will ride those market waves, and a fixed index annuity is going to provide the stability and that protection that's essential for anyone and everyone approaching retirement.
Yeah, and I think that it's important to be fully transparent here and letting everyone know that's listening out there that you should never be considering putting all of your assets into a vehicle like a fixed indexed annuity. It should be just enough to give you the peace of mind and confidence that you're risking off enough of your assets to still serve as a way to grow that money safely, but do so without taking unnecessary risks. So think of it like a bond position. Like when you look at traditional retirement portfolios, um, typically they're going to be an allocation blend of 60% stocks, 40% bonds, or sometimes you'll see a 50-50 mix or a 40-60 mix. And when you look at that, the point of those allocations is to be balanced. And when you look at bonds, bonds were instilled or implemented into that type of plan to perform when equities were down, so that half of your portfolio at all times was still able to do something in regards to a return. But what we've seen in these low interest rate environments over the past handful of years, and the volatility associated with bonds and interest rate environments, bonds can also lose value. So the traditional 50-50 portfolio that people would use or be their go-to in retirement, those can also cause a lot of stress and can also be very risky, even though you're in a balanced asset allocation. And we saw that just in 2022 when equities and bonds were both down and a lot of people's portfolios were significantly in the red. So when you think about positioning the fixed indexed annuity into your overall retirement plan, you really want to think about that FIA as a bond alternative, which we've discussed in previous episodes. You should be positioning that over there to act as a bond, but in the sense that you're shielding yourself from any downside risk that would be associated with a bond portfolio. But you're also in good years giving yourself very fair rates of return so that in the event you need income or need something down the road, you have this reserve bank that's been growing in that fixed indexed annuity that you can tap into, and you're never being forced to sell shares of a stock in a down market. So that's where that optimization comes in.
Yeah,
But
it would be interesting to see. If somebody speaks to their advisor now, like it's funny enough, I've got a call with my advisor tomorrow just to see what their opinion is now on the bond position today compared to maybe what their opinion was 10 years ago.
yeah, and I think it's probably changed
Yeah.
in a positive way, just because interest rates have gone up, which makes the coupon or the yield on that bond attractive. But regardless, there are alternatives to that. Not everybody wants to play that game. And that's where this fixed indexed annuity can be an optimal solution for somebody looking for alternatives.